It's time for the Trading Stocks Made Easy podcast. Each week, Trading Stocks Made Easy demystifies stock trading and investing so you can profit big. And now, here's the host of Trading Stocks Made Easy, the wealthy investor, Tyrone Jackson.
Hey, it's Tyrone Jackson, the wealthy investor. Welcome back to the Trading Stocks Made Easy podcast. All right, this is episode 253, and today you're going to get a lesson on tariffs, economics, and how to make money when a market is heading down. So if you're one of those people who really only trades and invests when stock markets rise, the thing that you may not know is there's a lot of money to be made when stocks go down. So when the market is dropping, there's a few things I want to share with you right now. Okay? All right. When markets are rising, that is said on Wall Street to be a bullish market. Wall Street loves using animals to symbolize things. When markets are pulling back, bears that represent retreat is what characterizes a market that is declining. Got it? Market rising, bullish. Market pulling back, bearish. Market not really going anywhere, neutral. I don't know why they don't have an animal for that, but it's a neutral market. We are right now in the middle of a somewhat bearish trend since our new president has taken office. Now, a lot of times when I talk about this new president, a lot of people think I'm choosing sides. Hey, listen, when it comes to stock market trading, investing, I am neutral because I'm in it more for the data. How can I teach you how to make money no matter where the stock is going, right? So politics aside, because I want to make sure that you're still able to make money in your cash account, in your IRA, and wouldn't it be wild if the value of your account actually grew when stocks are declining? So that's my agenda, not necessarily to discuss politics. Although today I have to talk to you just a little bit about politics, okay? All right. So in a bullish market, we are selling covered call options against our shares and taking in guaranteed income, which you know about, which is called the premium, and waiting to see if the buyer on the other side of that trade actually buys our shares away from us. That way we make money in a 2-week period, 3-week period, whether your favorite stock goes up, down, or stays the same, right? All right. Now, if we want to move on to advanced trading in a bullish market, I am selling call options to other people for income, but I am simultaneously buying call options. So a call option is a derivative. It gets its value from the value of the stock. Now, this is where a lot of people start to get lost, but I'm going to ask you in this episode to just keep an open mind. So when the market is bullish, I'm selling call options and I'm buying call options a year or more out, which is known as leap options. All right. Now, in a neutral market, to make money that I can actually spend every 2 weeks or every month, I'm selling covered calls that are further out in time, still bringing in income. Remember, when you sell a covered call, that money shows up into your account in T+1. So if I sell a covered call on Tuesday, I can actually go pull that money out on Wednesday, live off of the money that was generated by the call option, and I'm good. So I'm doing that in neutral markets and in bull markets. Now, in bear markets, where markets are pulling back, to make guaranteed income, I am still selling covered calls, but I'm selling covered calls with something called a trailing cost basis. You see, every time I sell a covered call, the right to a stock, it forces the purchase price of the stock to decline. That's why when you're trading in the style that I actually teach you how to trade in, you should be working with an accountant at the same time, because every time you sell a stock for a profit, you actually owe money to the IRS in the form of capital gains. All right, so I'm in a market that's declining. I am still selling out of the money covered calls, but it's affecting my cost basis because it changes the price at which I actually purchase the stock every time I take in that income. Therefore, I can say to you, it changes my cost basis. Now, I like to say this every once in a while. You know, when you buy a house, there's a cost basis for that house, right? If we're going to talk in accounting terms. So if I buy the house for $500,000, my cost basis is $500,000. When I'm ready to sell that house, the IRS says, what did you sell it for? And that would be my sale price. So if I buy the house for $500,000, sell the house for $900,000, my cost basis is still $500,000, but my sale price is $900,000. Therefore, my profit is $400,000. Got it? Okay. It sort of kind of works that way in the stock market, except the idea is every time I sell a covered call, my cost basis actually goes down. So in a down market, I still want to keep selling covered calls, pulling cash into my account, but my purchase price of that stock is actually going down. So anybody who's an experienced trader knows that you might as well be selling out of the money covered calls in a down market, pulling money into your account and lowering your cost basis. Now, let's take a look at another derivative, which is called a put option. Put options go up in value when your stock is dropping. Now, why would Wall Street create derivatives? Well, they would create derivatives so that when bull markets happen, experienced traders could make money. All right, so I've got call options. I want to own those when the market is rising. And I've got put options, which are going up in value when the stock that I own is heading down. So it's learning how to use both puts and calls so that when stocks are going down, you can do well. Now, I've trained a lot of people on how to be successful stock market traders. Most of them have been lay people who just don't have a huge financial education. They come to the Wealthy Investor Program and their life changes forever, right? Because in bull markets, I have them selling cover calls and buying calls. In bear markets, I have them selling out of the money cover calls to lower their cost basis, but we don't use puts. Wait, what? Tyrone, you just said put options actually go up when the stock is dropping. Therefore, shouldn't I be owning put options on my favorite stocks? All right. Well, here's where the game gets interestinger and interestinger, as my nieces and nephews say. Okay, I favor a trade when the market is pulling back because maybe something like tariffs are being enforced by the current administration. That is scaring the stock market. So what do you do to make money when stocks are going down? Instead of using put options, you would use something called spreads. Now, a spread is when you buy an option and sell an option against it to generate income. My favorite spread in markets like this are called bear call spreads. That means I am buying a call option and selling another call option against it, generally for a 100 or 200% return. I still own the stocks, but I want to exploit the fact that the stock is going down. Therefore, I'll keep the share, sell a covered call, and then set up a bear call spread, because every option I buy or sell actually has something called a life cycle. You see, when you sell a covered call, it expires on a particular date, right? When you buy a call, it also expires on a particular date. So now when I'm setting up a spread, because I bought a call and sold a call against it, I'm making my money off of time. I'm waiting for those two options to go to zero so I can keep all that money. Now, if this sounds difficult to you, continue to listen. Or you can go to thewealthyinvestor.net, download my free ebook, and start learning how to trade for profits when stocks are going down using spreads. Now, most of you who listen to this show, and believe me, these days I am thankful that you're here, you want to be experts when markets are actually rising, because that's what's happening 90% of the time. But now we're in a unique experience because of policy, and Wall Street does not like this policy. Your favorite stocks are going down. Now is the time for you to learn how to make money when stocks are declining. Back in a moment.
Want to increase your stock market trading profits? Then you need to start your monthly membership to WITradeschool.com right now. Don't understand how to write covered calls for monthly income? No problem. Simply review Tyrone's latest stock trades in our video library as many times as you need. WITradeschool.com is all about helping you get the financial education you need to earn money in the stock market and change your financial life. Tyrone Jackson, the wealthy investor, has helped his students earn thousands of dollars per month trading stocks online from home. These are people just like you. So what are you waiting for? Follow Tyrone Jackson's red-hot stock trades and investment strategies today. Don't wait. Start your monthly membership at WITradeschool.com right now.
Okay, and welcome back. Now, what we were talking about in our episode today is how do you make money when stocks are going down? Well, you set up spreads instead of buying puts. At least that's my favorite way of making money. So who is making money? All right, let's talk about it. So now, on Wall Street, there are mutual funds, which is nothing more than a basket of stocks that you let someone else buy and you put money in on a regular basis. There are a variety of different funds on Wall Street, but my favorite fund is called a hedge fund. A hedge fund requires that you have at least $1 million to invest, and then that fund goes and makes money off of your money, and much of the money that they actually earn is from covered calls. So you're paying them to do the job that you don't want to do, right? Which is manage the money. And in exchange for that, they're actually taking a fee of profits on a regular basis. So it's really hedge funds, not mutual funds, that make money off of put options and spreads when stocks are going down. Now, as stocks are going down, options are running out of time. Therefore, I'm keeping all of the money that I earn from spreads, but I'd have to be selling a lot of contracts. So what is a contract? A contract is the right to control a stock up or down without even owning the particular stock. And that's what derivatives do. They allow you to control or profit from stocks that you don't even own. So if there are companies that I'd like to own, but I notice that their prices are actually going down, I'm going to set up spreads on that company's shares, and I'm going to make a bundle without having to own the shares. You see, I used to say this when I first started this show 7, 8, 9 years ago. The stock market is one game and 100 ways to play it. But since the market is mostly bullish, most people don't want to learn bear market strategies because they're so happy to be generating profits like covered calls and volatility trading when markets are going up. But they all want to learn how to make money when markets are going down. Now, statistically speaking, bear markets don't last too long. The average bear market is 8 weeks to maybe 4 months long, because the thing that causes the market to go down is known as a catalyst, a negative catalyst to be more specific. So when the market has negative catalysts out there, negative catalysts traditionally don't last too long. Which, if history is of any judge, what's going on with the Trump administration and the enforcement of tariffs probably won't last too long because it's causing the U.S. stock market to rapidly decline. Not only are U.S. tariffs causing the U.S. stock market to decline, it's causing markets around the world to decline because those markets require that publicly traded companies actually sell things to other countries around the world. Now, I know that this is a lot to kind of take in, but we live in a world that is interconnected, economically speaking. Here's the upside. If you could learn how to use bear market strategies right now, you would make a lot of money that would surprise you, because most people think of stocks as rising all the time, and that's the side of the trade you want to be on. Well, there's certain traders on Wall Street, and they're usually hedge fund traders who learn how to make hundreds of millions of dollars in a neutral to bearish market or neutral to bearish stocks. Why do some people make their fortunes on stocks that are quickly dropping? Because it's like a crowded movie theater. When we all want a stock or we all want to see a movie, we come in nice and calm. And one person always goes, I'll get the seats and then you get the snacks. But if there was a fire in that movie theater, we don't leave in a calm manner. We all head for the exit all at the same time. That's what's happening today, right now, March 28th, 2025, is everyone is heading for the exit. Now, one last thing before I go in this episode, because there's an awful lot to think about. There are certain institutions and certain traders who prepare constantly for a major pullback. So that's why we've been getting a lot of movies in the last 5 years about stock market traders who make a fortune when the stock goes down, because it's a very fascinating side of the game. To do that, I believe you have to be an inherently negative person who's always looking for bad news so you can own derivatives like puts or spreads. I do not have that orientation. I am very hopeful about the present and the future, so I don't like scouring the markets for companies whose stocks are failing, although you can make a lot of money on the derivative side when that actually happens. There are other traders who are constantly practicing for a bear market because they want to be good no matter what the direction is. So if you have money in the stock market, again, it goes right back to that financial education. You're the one that's going to have to decide how educated you want to be. You're the one that's going to have to decide what derivative plays you like and what stocks you feel are more susceptible to actually major declines when the market as a whole is pulling back. So you have a lot to think about, but here's what I want you to know. There's a lot of money to be made when stocks are actually dropping. Why? Everyone is heading for that exit door all at the same time. We come in quietly, we leave in a panic. So if your favorite stock is dropping, here's what I want you to think about. You could sell covered calls against them while simultaneously setting up spreads and owning puts. That's a lot for you to take in, that you can do all of that on one stock. In fact, on your favorite stock, there's always 3 ways to make money guaranteed off that stock, whether it's bullish, bearish, or otherwise. Head to thewealthyinvestor.net right now. Download my free ebook, because I actually have some classes coming up that are all online on how to make money when stocks are declining. And I want you to have this information sooner rather than later, so you're never in a panic. You're always generating profits. And that, my friend, is no bull. All right, I'm Tyrone Jackson of thewealthyinvestor.net. I hope to see you over on the website and take one of my classes online. Even if you're not trading, it's a hell of an education. And this show is all about you getting a financial education. I'll see you next time right here on the next Trading Stocks Made Easy.
You've been listening to the Trading Stocks Made Easy podcast. Be sure to rate and review our show on iTunes. While you're on iTunes, be sure to click the subscribe button and you'll automatically receive our next episode.